Hi, this is the Entrepreneurship series. I wanted to talk a little bit about sort of financials basics. I've got a couple videos on here in this series about various parts of the business plan, and this is a continuation of that component of the Entrepreneurship series. I'll be talking about a lot of other topics as well, but first things first, we need to kind of get through business plan components and basics and things that every entrepreneur needs to know. And things that need to be included in every business plan so that you make sure you present yourself in the most effective manner to your investors or the bank if you're going for a loan. In the financial section of the business plan, which I typically do as the last section of the plan as an appendix, basically, the actual financial statements, what I tend to want to do ideally is you want a minimum of 3 years of data, but I tend to put 5 years of data in the plan. Unless it's a sort of a lower price basic type of plan. But ideally you want to present 5 years of financials. I think that's the appropriate number of years for the forecast. I like to include a full set of financials, meaning an income statement, a balance sheet, and cash flow statement for all 5 years. And I typically would want to put months, everything by months, on all 3 of those statements for the first 2 years. And then I do quarters typically for the year 3 through year 5. Unless there's some reason to add additional detail, and I may do months for all 5 years if that's the case. That's the basics. So for example, you want the full set of financials, so you have 5 years of income statements, 5 years balance sheet, 5 years cash flow statements. Within that, or in addition to that I should say, a lot of times I'll build a revenue model depending on what type of business. If it's a super simple business, they have one product, there's no need to do that obviously. In the income statement, you can have your top line revenues, you can have your cost of goods sold if they're selling a product, and then your various expenses, etc. in the income statement. However, if it's a company that is going to be selling multiple products or services, a lot of times it's appropriate to build a separate revenue model that details out all those different revenue sources and any associated cost of goods sold with those revenue sources. And I tend to build that out as a separate table that's going to go into the business plan. I think that's a great way to add additional detail to provide more analysis for the potential investor to look at, or a bank if they want to really understand where the revenues are coming from. It's also a nice way to highlight the fact that you're not dependent on a single revenue source. You have multiple products or services where there are multiple revenue sources coming in. So if any one of those revenue sources does not perform as expected, you've got other ones that could offset that, or perhaps do better than expected that would again offset the one that underperformed. So if you have multiple sources of revenue, it's a good idea to have that. And what I'll do, I build everything in Excel. I'll link the revenue model to the income statement so that I can feed the income statement single revenue line with the revenues from the revenue model, the total revenues from the revenue model. That way on the income statement it's really clean. You've just got a single line for revenues, you've got a single line for cost of goods sold if you have any, and then the detail for those items again would be contained in the revenue model. That way you can keep the income statement clean. Obviously if you want to, you can put multiple revenue, if you, for example, have 2 or 3 revenue sources and you just want to put those in the income statement, you can certainly do that. I've done that before. Likewise, if you have cost of goods sold for 2 or 3 different revenue sources, you can just put that in the income statement as well. I've done that again, but I prefer to do a separate revenue model just to keep the income statement as clean as possible, and the income statement then becomes sort of a consolidated, if you will, or streamlined statement so that you can keep it very clean. If you move down a little bit in the income statement looking at expenses, I do always include depreciation and amortization on anything, items that you have, upfront expenses, for example, for equipment or build out of a location, or software development cost or whatever it might be. I would include that non-cash item as an expense line item in the income statement, because I believe you definitely want to show that. A lot of people like to do more like a profit loss statement rather than a true income statement. That's okay. If you want to do everything on a cash basis, that's okay. You can even get away with doing that and then not even having a cash flow statement. But for me, I prefer to build a standard set of financials. There are a couple things beyond that. You can include taxes if you're looking at the structure. For example, if the structure of the business is going to be an LLC and it's going to be a pass-through, you may not want to include taxes. you can assume with an LLC it's going to be taxed like a corporation, for example, or you can assume that it is a corporation, it's going to be taxed at the company level and therefore include taxes. I like to include them just to make the assumption that taxes are going to be paid, because taxes are going to have to be paid whether it's at the company level or later on from an investor if the money's distributed. It depends on how you want to represent it. If you want to keep all the cash in the company because you're doing a lot of ongoing CapEx expenditures, for example, and you need the cash to remain in the company, and you're not going to distribute it, and it is an LLC, for example, and there won't be taxes on the earnings, great. Represent it that way. You need to understand those rules as you're building the financial table out and make sure everything lines up and makes sense, with the type of business and the structure that you're going to choose. A lot of times it's good to, if you have specific investors in mind, find out what they want as far as a structure. They may want a subchapter S, for example, or it may make more sense for them to have an LLC because they want to pass that through and they want to control their own tax situation. Whatever it may be, some investors have their own ideas, so sometimes it's good if you know who the investors are that you're approaching, it's a good idea to communicate with them and find out what kind of structure they're looking for, and then represent the financials with that structure in mind so that it makes the most sense to the investors. A couple of other quick things. Obviously, I said that normally I put the financials as an appendix in the back. That's always true. That's the way I build business plans. But I will put a summary table with graphs and things like that in the executive summary, summarizing revenues, EBITDA, or earnings before interest, taxes, depreciation, and amortization, which is kind of a proxy for cash flow. And then I'll also put EBIT, earnings before interest and taxes, and net income. If I'm assuming a loan, in the income statement there'll be interest expense, and in the cash flow statements and the balance sheets there'll be the loan balances and the principal payments in the cash flow statement, etc. So you need to think about that. If you're going to represent it, you want to go to a bank or an investor for a loan, then you want to represent a loan as your capital source, and you want the financials to appropriately reflect that capital structure. So if that's the case and there's a loan, in the summary table I'll typically include total debt service, which would be the total on a yearly basis of the principal and interest payments for the year. And then I usually do a debt service coverage ratio, basically, which is EBITDA, your cash flow, your actual cash generated, divided by what your total debt service is to get a number. And normally banks like to see at least a 2 coverage ratio there, so kind of keep that in mind if you build the table out that way. If you're above a 2, that's probably going to look pretty good to the bank or investors. The higher above 2, the more cash flow coverage basically you would have on an annual basis for the loan, and that makes the bank feel safer with the loan, etc. So those kind of things are important. I talked about valuation in another video, but obviously you can use the EBITDA as your one of your metrics anyway to calculate some kind of a valuation based on year 5 EBITDA. That's always a good thing. You can do a multiple of 5 or 3 or whatever's appropriate for the industry that your business is in, and you can use that table to put in there some valuation metrics if you like, which I typically would do unless there's a reason not to do it. So in a nutshell, that's kind of an overview of the financials. In the future I'll be doing some more in-depth analysis of various aspects of the financial tables, but in general that's the way I like to approach it.